Right. Check, check, radio check. I think my audio and video is working, but if somebody wouldn't mind typing into chat that all is good, that would be great. There we go. Thank you, Kate. All right. I'm back as I was mentioning right before the call started. I've been running hard. Last week was my first week back. Getting back into the habit and tradition. Thursday's weekly chat with Chris. And obviously, this topic this week will be what's your core investment strategy? And we're going to talk about that a little bit. But before I get into it, you may remember from last week, if you were on the call last week, great. If not, it'll be, sort of my observations. And part of what I've been talking to clients when we're doing reviews is, there's headwinds in the forecast. And I had said at the beginning of 2023 that Q3 and Q4, I think, would be under pressure. I think that's gotten kicked out a little bit to probably Q1 and Q2 of next year, but I still think it's coming. And the reason that I feel so strongly about this is because 30-year mortgage rates have hit 8%. I haven't seen 8% in a long time, but those are high numbers and make home ownership difficult for our youth. And all the things associated with real estate and homes and purchases and affordability. So I mention that to you because I do think for the first time that I've seen ever in my life, a drift away from traditional investing philosophy. So if you recall, if you're still working, those asset allocation models that we typically see, 60-40, 70-30, 50-50. And the reason that we promote those strategies is because that for every 3 to 4 to 5 up years in equities, traditionally, there is 1 to 2 down years in the equities, and a shift to bonds often was a flight to safety or a way to still be able to recover. That no longer seems to be the course right now. We'll get more into that as we talk, but I just am concerned that not only with the geopolitical risk and specifically, Israel and the horrors that happen there, but, political risk in our own country, coupled with inflation, coupled with uncertainty in the market, I think there's storm clouds on the horizon. So this is not a panic call. This is not a, upend your entire investments. Actually, you should be in the market. The question is, how do we be in the market with some thoughtfulness? And that's, again, why I'm bringing to the surface. It's been a while since I've promoted some of Brookstone's, who's my RIA, that stands for Registered Investment Advisors, investment options, right? And we're going to start with this week will be on core investment strategies. And then next week, we'll talk about how you can bolt on maybe a satellite to help give us options. So without further ado, thanks for listening to my intro. So start investing with a core raise, which is trademark philosophy, core plus satellite. So what we're going to talk about is this center, nucleus here, and then these satellites that can be options for specific to your needs, right? And everybody's needs that are on this call or listening on LinkedIn or in the future on YouTube will say, hey, your needs are different than the person sitting next to you in the cubicle next to you or your neighbor next to you. And so thoughtfulness should be given to your specifics to design something that is applicable to you. So Brookstone's raise investment approach, when attempting to strike a balance between risk and reward during volatile markets, it's critical to consider the negative effects large drawdowns can have on long-term returns. Brookstone's risk appropriate investment strategy and valuation raise process is designed to mitigate drastic downturns so investors can take advantage of the benefits of compounding. Each aspect of our raise investment selection process is dependent upon rigorous research and active management to help manage risk and capture gains opportunistically. So you can see each of these boxes: risk, assess your current investment mix; appropriate, formulate your risk profile; investment, identify the investment universe; then we have strategy, which is determine an appropriate investment mix, and then ultimately implement the strategy. So that's going to be why I wanted to introduce that. Brookstone has, quite a few core investment philosophies and can even custom tailor philosophies for the investor. But starting with the investing, how much do you want, how much risk do you want in your portfolio, and how much do you want it to absorb? And my takeaway here, there's a bunch of numbers on the screen, but that middle word, average, right? That's what we all tend to gravitate towards. What is the rate of return that we're looking to achieve, whatever that average is, right? And you could see that if we go all the way to the left, we have 100% bonds in our holding, or all the way to the right, there's 100% stocks in our holdings. And we can see the variance or the swings, right? We have positive 54% to a negative 43%. And that's from 1926 to 2018. So you have your best to your worst. So the question is, can you absorb or handle those swings? Now, one of the things that may not be as obvious is that, all the way to being in the bonds, which would have in the past been considered safer, you actually might do better with an average to be somewhere in the middle with about a 50-50, right? So you may be able to achieve a little bit more with a little bit less risk. So that's where the blending and the diversification comes in, right? So I wanted to emphasize that. So when we're looking at and we're asking those questions, there's something called a risk profile questionnaire that we will quite often send a client. We have to send to folks to open a new account. And then, if somebody's risk, temperature or their risk, tolerance changes, right? Then we will typically send that back to them and say, hey, what's changed in your life and how do you feel now, right? So the first is a strategy called the Raise Select models. And basically it offers investors a conceptually sound decision-making framework designed to be competitive throughout changing investment markets. By seeking a risk-appropriate diversification target, these models are meant to help clients exercise patience and discipline. And that's what most people lack when they're investing, right? Is that we're emotional, we're not robots. Across all market cycles, based on their tolerance for risk, the Raise Select models are built to help achieve a sensible balance of investment trade-offs. So key features, they couple strategic plus a tactical blend. Tactical means that there is a little bit of hands-on. They also have a little bit of active, right? So they're using technical indicators. They have rules that they typically will look at and try to capture some of that alpha, which might otherwise not be there with a buy and hold strategy. And then attributes, potential to mitigate severe bear markets. And I do believe that we are starting to head into, I heard today that we're drifted into bear territory. What does that mean for the future? I don't know. I'm not gloom and doom. The sky's not falling. But we should know the difference of, hey, do we have a strategy in place that helps us to protect? Should we enter into unique arenas versus what I call should on ourselves? Are we, I should have done something. I should have gotten out. I should have done this. Monday day quarterbacks. And I don't feel that's prudent or necessary with a good investment plan long term. And then guiding principles, broad unbiased opportunities. Portfolios take on an agnostic approach through thematic factor and asset class lenses. It's a risk-first mindset. So that's really, really important, is that we have to make sure that we're risk appropriate, and the risk managers and the portfolio managers work together to fine-tune exposures to stress test portfolios. So stress testing, that's something just, basically looking at it and saying, hey, what happens if this happens? How much does that affect our portfolio? And then flexible dynamic portfolios. Portfolios combine multiple investment approaches and nimbly adapt to changing market conditions. So that's the select series, right? Now, the STAR models, a little bit similar, but you're going to see something here that I think it's important, but it's a globally diversified blend of passive, which means buy and hold, versus a little bit of active components. Engineering using a range of equities and fixed income vehicles. Our aim is to provide investors a flexible yet disciplined portfolio allocation framework so that they can choose the portfolio that aligns with their specific risk profiles. Now, again, you see passive and active are blended together, and they're brand name and some boutique money managers, and then recognize industry leaders in passive investing. The attributes: active fund manager selection will allow general market direction and potential to generate alpha, right? So that just means above average yield or returns. Now, the one thing that this chart jumps out at me, it's by Putnam Investments, is that this is, as an advisor, we are presented with studies over our career that show us that timing the market is not only difficult, but I would go so far as to say impossible. And so the key point here is that by staying invested, right, it allows us to capture that lost opportunity cost that most investors face because they miss the top performing days, which can hurt your return on investment. If you miss the 10 best days versus miss the best 40 days, right? And we do that because, we don't have crystal balls. We're not robots. The talking heads, as I've mentioned on here before, want us to, they have to share news, whether it be greed or fear. Those are the two pieces of information that flood our airways. And so with that, the markets will adjust. And sometimes if we're not robots, so because we got out, we may have gotten out, right, and sold at the low, only to re-enter into a higher point, and we miss some of those gains. So, that's what this helps to alleviate. But again, we must have the tolerance and the risk guidance or just going through our profile questionnaire to make sure that you're suited for your emotional and personality overall. So the Smart Beta series is a type of investing that tries to improve the risk and return of the traditional market cap-weighted indexes. This innovative approach to investing has broken down investing into factors that have studied rigorous academic study. So there's key features: smart beta, minimum volatility approach, implemented with innovative ETFs, reduced overall portfolio volatility, attributes backed by rigorous academic research, and then experiences moderate tracking error, and then traditional allocation with smart indexes. So it's just, a minimum volatility ETF. This is the symbol USMV, right, relative to the S&P. And it will capture some of the upside, measures the portion of the market returns captured during positive months for the index. Downside capture refers to the portion of the market captured during negative months for an index. So what are the factors they're looking at? Minimum volatility or lower risk stocks, right? So that's what they're looking to have in this USMV holding, right? Quality, companies with healthy balance sheets, right? Value, stocks that are cheap relative to their fundamentals. Momentum, stocks on an upswing, and there's wisdom, whether it be scientific or academic, there's been studies that show that, you don't break or try and break a trend, right? You don't bet against the momentum. And then size, smaller, more nimble companies, right? So all these factors make up this smart beta series. And then again, your core doesn't necessarily have to be one or the other. You could maybe have a blend of cores, right? So that maybe it's the select series and the smart series. So everybody's different, but you can experience some of these holdings as well. Now, the strategist series, there's some unique strategies out there, and it basically utilizes diversified portfolios designed to offer investors access to portfolios inspired by popular strategies and implemented with low-cost ETFs. So, the key features: strategically designed all-weather portfolios, tax-efficient, low-cost ETFs, and time-tested allocation strategies. Attributes are simplicity, clarity, diversification, unique tax-efficient portfolio designs, and blends well with other holdings. So the desert portfolio is a way to combine simplicity and theory with only a 3-asset portfolio. It can be used for small accounts or as a simple passive core portion of a portfolio. All season. The all season portfolio was inspired by Ray Dalio at the time, the founder of the largest hedge fund firm. He provided guidance on portfolio that can be implemented for individual investors. Golden Butterfly. The Golden Butterfly portfolio was inspired by studying the history of the permanent portfolio while combining the best features of diversification into an efficient allocation and accumulation and retirement. Coffee House. The Coffee House portfolio was designed by Bill Schulteis, a long-term investor and columnist that espoused a philosophy of an asset allocation designed to capture the broad market returns. And then University. The University portfolio is a portfolio inspired by the popular university endowment models designed for individual investors. So again, it's just another option to maybe consider to build onto your core. And as I mentioned, next week we'll be on satellite. And then lastly, sustainable strategies. So, you may know them as ESG investing. ESG investing seeks to achieve a more sustainable outcome while pursuing your financial goals. One of the things when I first heard about ESG, Brookstone had said they follow the money. When something seems to be starting to show or rear interest, they're following the money. And that was why they put this onto their platform. And then now that it's been there for 3 or 4 years, the amount of money globally that has moved into these ETFs and arenas has been substantial. And really the ESG, the E stands for environmental issues. Things that are important to people, right? Whether it be climate change, pollution and waste, environmental opportunities, identifies companies that pose less environmental risks than their peers, and they put that into their portfolio. Social issues, right? Human capital, product liability, social opportunities. They identify companies that promote strong relationships with their stakeholders. And then governance, right? So the government, corporate governance, ethics, corruption, instability, identify companies that promote transparency and diversity. So it's just really trying to give us this holistic approach to investing while meeting a lot of what seems to be a lot of the media and society seems to think is important. The demand. This is why it's something to take notice of, right? Asset owners, so people that large holdings, pension funds increasingly demand sustainable investment strategies from their asset managers. Asset managers, ESG analysis incorporated into fundamental financial activities. Legislation, redefining fiduciary duty concept. And then retail investors, higher percentage of women and millennial investors are demanding ethical sourced investments. So all these things combined are helping to shape investing into the future. And this is on our platform. And I have clients that have said, hey, I really like that. And I want to have a portion of that, my holdings in that type of philosophy. So lastly, we're going to get to my notes. I do want to say that if anybody wants to get copies of the consumer brochures, or you want to see a performance history on any of the investments, investments from Brookstone. I have that stuff. Just send me an email, chris@professionalplanningservices.com. Happy to share that information. Anybody in my office can get it to you as well. And like I said, next week we're planning on speaking about satellite. We're going to talk about some of the things and offerings that Brookstone has and how you can bolt this on to help give you a diversified portfolio, mitigate risk into the future. I want to thank each and every one of you for being on the call this week. And again, don't keep me a secret. And if I can help you in any way, please reach out. Thank you.